We are all taught to keep our money in the stock market at all costs. You're 30, 40, 50, 60, 70 years old, and every time your advisor, and in fact, it's not just your advisor, it's everyone. You probably tell yourself you can never take your money out of the stock market. And so what people do is they put their money in safer parts of the stock market during scary times. And I absolutely need to talk to you today about those safer parts of the stock market and what's happening to them, because it is not good. They are actually saying something to us, and what they're saying is the market's getting weaker. So we're going to look at those quote unquote safe parts of the stock market and how they are cracking and what to do instead. Stick around, we'll get to that and so much more. Hey everybody, this is RC Peck here with my weekly update with Fearless Wealth, and we have a lot to cover. I'm going to cover 4 symbols. 2 of them are the safe symbols where people have been taught to have their money. Even if they don't want to have their money in the stock market, we've all been taught that you never, ever are allowed to have your money taken out of the stock market. You know, you got to believe, you have to start to really think about whose system that is, where you're never, ever allowed to take your money out of the stock market. And then on to 2 other stocks, aggressive stocks you're never allowed to buy. Okay, so let's do this. Let's start with this symbol right here. We're looking at a price chart of utilities. It's a utilities tracking symbol XLU. And it's telling us bad things are coming. Bad things are already happening. Now, I already put trend lines in place, and you can see. Now, here's the thing about XLU. It's actually only down. Let me pull on. Let's see. It's only, from the start of the year, it's only down about 9%. Now, in context, that's pretty great, considering the S&P is down about 23 or 24%. Having a sector only down 9% is pretty good. But here's the problem with it. It broke out of its uptrending kind of direction, and it tried to get back into that uptrend, but it couldn't. It was denied, and now it is breaking down. Now, what's more important is it's breaking down below its pre-COVID peak. And if you followed any of my videos or watched any of my videos, you know that when a symbol is breaking or has broken below its pre-COVID peak, it's a sign of great instability and weakness. And that's what utilities are doing right now. Now, this is a price chart including the dividends being reinvested, which means it's harder for this line to go lower, but it is breaking down below the pre-COVID high. I also want to point out that utilities back in the COVID crash fell 36%. For reference, the S&P only fell 34, and the NASDAQ 100 QQQ only fell 28. Now, the reason I bring up the COVID crash is because the people who own utilities are almost all over the age of 60, because they've been taught utilities are safe. You can never get your money. You're never allowed to put your money out of the market. So if it has to stay in the market, I guess I'll put in utilities. And utilities got absolutely crushed. Maybe that's a little hyperbole. They fell much harder than even the NASDAQ 100. And here utilities are breaking below and not able to get back into their uptrending channel. So that is another sign of weakness. The other price chart I want to show you is the Invesco S&P 500 low volatility ETF. Now, this is a great, it's just a lovely named symbol, low volatility. What do you think that's saying to people? Low volatility, what does that mean? It means you're safe. You will have your money when you need it. It is being protected. But as you can see on the screen, it is nothing like that. In the COVID crash, this low volatility symbol fell more than the S&P. It fell 36%. S&P only fell 34. The NASDAQ 100 only fell 28%. So this low volatility symbol fell harder than even the NASDAQ 100 QQQ. And if you look at the screen, we now have low volatility S&P breaking below its pre-COVID high. This is a sign, it's really important. This is a sign that the men and women, the investors, the people over the age of 60 are saying, you know what, I'm done. I'm done. I want to stay retired. I'm not going back to work. I don't want to be a greeter at Walmart. I have to protect my money. I don't care what my big box advisor is saying. I'm moving my money to cash. That's what we saw in the COVID crash. So, and the reason why it's important to understand what people over the age of 60 are doing is they basically have the majority of the money in the stock market. So the men and women over the age of 60, it's, 50s, 60s, 70s, 80s. I think baby boomers and the greatest generation. They're starting to throw the towel in. So we're going to start seeing an acceleration, or it's very, very likely we'll start seeing an acceleration of the stock market to the downside. Now, I want to show you something. This is the NASDAQ 100, if you look at the screen here. And this is the .com crash. So I have a approach. I use what's called market-based rebalancing. Now that's my term, market-based rebalancing. I rebalance people in or out of the market based on the market itself. And so here's the NASDAQ 100 QQQ. I rebalanced people out based on the strategy that I followed. They got out at 68 bucks in the .com crash. They stayed out of all the drama, and their money got moved back into the NASDAQ 100 at an average price of 26 bucks. So there were 4 signals out, and the average out price was 68 bucks. And then they went for a few years, and then they got back in. This is how you protect your life savings, by having these circuit breakers. Now, I call it market-based rebalancing. That rebalances you out of the market when literally the market is telling you, get out. The previous 2 years before the NASDAQ fell 83%, it was actually up 400% in a little over 2 years. But the point is, implementing a market-based rebalancing approach, which is how I manage people's money, is a way that allows you to be in the strong part of the market, the NASDAQ 100. And it protects, it kind of caps your downside, right? So it's kind of like have your cake and eat it too. You get the strong growth of the market when the market is good, and you protect your downside when the market is sick. Okay, the last thing I want to show you is this company called Pinterest. Most of you have heard of this company, Pinterest. It IPO'd, it went public in 2019. Okay, it's behaving really interesting right now. It stopped falling. It stopped falling. Now, you might think, RC, it already fell pretty big time from the beginning of 2021, but it has stopped falling. And I'm looking specifically over here, kind of since June. It started going up in June when the market went up in June. Okay, but here's the thing, it has not fallen. It is still going up. I believe a Google or an Amazon or a Microsoft or a Facebook is in talks to buy Pinterest. There is no other reason why this stock is not falling other than a massive, huge trillion-dollar market cap company saying, you know what, we'll buy Pinterest. Right now it has about a $17 billion market cap. That means they're going to have to pay a premium for it, maybe $25 or $30 billion market cap, which means it could maybe, let's see, if it went up to 30, a $32 billion market cap company would put it up at 50 bucks, right? It'd have to double in price. It's probably not going to be bought out for 30 billion. But don't be surprised if you hear an announcement that PINS, P-I-N-S, which is the ticker symbol for Pinterest, is getting bought out by a Google or a Facebook or an Amazon or even a Microsoft. This is what's great about looking at the market itself and not economics or not other tracking fundamental information, but really understanding that, look, when something is going up in price and quote unquote shouldn't be, then that means there's something else going on. And I believe PINS, which is Pinterest, is in talks with a major tech company to be bought out. Okay, so let's put all of this together. The safe parts of the market are starting to break down. that is not a good sign for the overall market itself. So that's the first thing I want to kind of wrap up here. The second thing is we've been taught that you can't be in those strong parts of the market like the NASDAQ 100 QQQ because they're really dangerous. What you own is your strategy, not the symbol. The NASDAQ 100 or triple Qs, it's not dangerous. It's how you own it that matters. And so what we do at my company is we use something called market-based rebalancing. We look to the market to tell us when to rebalance, not the year we were born, not how old we are, not, the 7 questions we answered on a Tuesday, but we just look at the market and say, market, should we be in? Should we be partially in? Should we be fully out? And then lastly, just one of the neat things about understanding how to kind of think with your eyes with investing is you can start to find opportunities that should not exist. And I believe that Pinterest is about to get bought out, and we're going to hear an announcement in the next 60 days that an Amazon or a Facebook or Google is buying them. Thanks everybody for being in my world. Let me know where you think I got it right, where you think I got it wrong. You do not have to suffer when the market falls. Back in 2000, even though the NASDAQ 100 fell 83%, my market-based strategy stepped people out of the market, rebalanced people out of the market so they did not take that hit and kept their money safe until the market stopped falling and went up. There are things you can do with your money. And if your advisors are not talking about ways to protect it outside of moving it into utilities or dividend stocks, then you may want to have a conversation with us. Thank you so much for being in my world. If you do, it's super simple. You can just email us at hello@fearlesswealth.com. Okay, thanks. That's it for this week. I hope you guys have a great week, and I will speak with you next week. Okay, bye.